Happy Monday, everyone, and welcome to our OakBridge weekly market webinar update. We are grateful for everyone that has joined us today, and we are going to jump right in. We've got some information that we want to share today that we had our recent jobs report come out last week, and one of the things that the Fed is looking for is a increase in the amount of unemployment. They want the jobs to be a little less robust than what it is. And you can see here on this chart, what this is telling us is this is the number of job openings compared to the number of people seeking jobs. And you can see that in April of this year earlier, that it was at a 2-to-1 ratio. What that means is for every one job opening, or for every two people that had job openings, there was only one person searching for that job. So a lot of additional jobs above and beyond those 2-to-1 ratio as far as those jobs that were opening versus those that are available. You can see that this has come down a little bit, which is exactly what the Fed is looking for. It's now down to 1.7. However, it is still above pre-pandemic pace and has a ways to go, but it is flashing signs of weakness. So at least from the initial standpoint, it seems to be doing what the Fed is asking it to do. And based upon this jobs report, it looks like that the Fed is going to stop or start decreasing the amount of interest rate hikes that they have, or decreasing the percentage of hike. And we'll go from probably in next week from a 0.75% hike as we did last month to this month, they'll probably just do a 0.5% hike. So those are good things. The Fed is slowing down the rate of increase in the rising of the interest rates. And for all intents and purposes, that's a good thing. They're trying to pause a little bit to see where things are going to be and where they're going to land. It looks like, based upon everybody's tea leaves that they're trying to read as far as what's going to happen with a recession or no recession, right now they're pricing in about a 46% chance of a recession. However, with that stated, I broke one of my rules today, and I've included 2 slides instead of just one today. And this is showing the bank ratios. And this is the amount of money that banks have available to lend or to protect themselves against a catastrophe. And one of the things that they do in the banking industry is that every quarter they do a stress test. And that stress test is designed to see if the banks can be healthy and remain healthy and still lend to the consumer, even under extreme stress scenarios. In these scenarios, they assume that we'll have a 10% unemployment rate, which right now it's around 2%. They also project in these stress tests that the stock market will drop substantially, liquidity will dry up. I mean, they just really throw the everything at the wall and see what's going to stick, and just to try and figure out whether or not the banks are healthy or not. And you can see here in this chart, the green is what's required by the banking industry or by the regulators as far as the liquidity that they need to have. And you can see over here that in the worst case stress test scenario, that we're almost double what the bank regulations are considered appropriate for as a minimum amount of liquidity. And so from a banking standpoint, it looks like that the banks, even if we do have a fairly severe downturn in the economy, even if the Fed calls it wrong and everything just drops out from underneath it, it still looks like the banks will be lending, which is a key component to helping recover out of a recession. And so from that standpoint, it looks really good. There's still a lot to be looked at. There's still a lot that's going to happen. We continue to expect volatility going forward. We've had a nice little run in the market up to this point. We expect the markets will still continue to be volatile, probably through the first quarter of next year. After the first quarter of next year, we feel that more than likely the market will have been able to digest what the Fed is doing and digest where things are going, and be able to, instead of just trying to get out in front of something, that they'll have some data that they can trade on and some data that they can make decisions on. And one of the things that's happening right now in the market that's kind of interesting to me is as I listen to commentaries, there's a huge FOMO or fear of missing out that's being experienced by the traders right now, or the institutional investors. They understand that there's going to be volatility in the marketplace, but they also understand that there's a high likelihood that there's going to be some significant rallies within the marketplace, and they don't want to miss those rallies. And so what that means to the marketplace is that we're probably going to see a little bit more organized of a increase over time, just because of that fear of marking out. Fear of missing out. It keeps money in the market. It keeps people invested, and should tend to moderate a little bit of the volatility that's coming forward. Now, with that said, we still do expect volatility. We just don't know in what form that's going to look like. But that's it for today. Thank you so much for joining us. As always, if you have friends, relatives, co-workers, associates that you feel like might benefit from our weekly podcast, you're welcome to forward that link to them. Again, thank you for joining us, and we very much appreciate your participation with us as we do these. Thank you again. Bye-bye.